Hello and welcome back to the channel, where we break down complex market mechanics into actionable insights. Today, we're diving into a fascinating corner of the market, hard to borrow stocks and the potential for short squeezes. We'll be focusing specifically on a ticker that's caught our eye recently, WLDS. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show WLDS logo/ticker on screen. Let's talk about WLDS. This is a microcap company, and while its specific sector isn't readily available, what stands out are some unusual metrics. When we look at recent price action, WLDS has been remarkably flat. Today, the stock shows a 0.0% change. Looking back over the last 5 days, it's also at 0.0%, and the last 30 days are no different, sitting at 0.0%. Now, for volume, it's been equally quiet. Today's volume is 0 shares, with a 30-day average volume of 0 shares, resulting in a relative volume of 0x average. Zoom in on CTB number. Despite this quiet activity, WLDS recently appeared on our hard to borrow screener, registering a composite squeeze score of 48.0 out of 100. This score, combining factors like cost to borrow, borrow supply, and flow size, suggests a moderate level of underlying interest that warrants a closer look. What is cost to borrow and why it matters? So, what exactly is cost to borrow, or CTB, and why should you care? Show animation of short selling. When you short a stock, you're borrowing shares, selling them, and hoping to buy them back later at a low price to return to the lender. But borrowing isn't free. Lenders charge a fee, known as the cost to borrow. This fee is typically expressed as an annualized percentage. When a stock becomes hard to borrow, it means there is high demand from short sellers and limited supply of shares available to lend out. As demand for borrowing outstrips supply, the cost to borrow skyrockets. A very high CTB can be a red flag for short sellers because it makes holding a short position very expensive, very quickly. Why this stock is hard to borrow right now. Highlight CTB for WLDS. This brings us back to WLDS. Our data shows an eye-popping annualized cost to borrow fee of 10.03.7% for WLDS. To put that into perspective, most stocks have CTB fees well under 10%, often even under 1%. A 1000% plus fee is an extreme outlier. This indicates that borrowing shares at WLDS is incredibly expensive right now. Show estimated float. We also note an estimated float of just 1.9 million shares. A smaller float means there are fewer shares available for trading and for shorting, making any significant short interest even more impactful. While the exact number of shares currently available to borrow for WLDS is unknown, the massive CTB fee suggests supply is extremely tight. This combination of a tiny float and an exorbitant borrow fee is precisely why WLDS triggered our screener. Squeeze mechanics explained. So, what could this mean for WLDS? It ties directly into the concept of a short squeeze. A short squeeze occurs when a stock's price starts to rise, often unexpectedly, forcing short sellers to buy back shares to cover their positions and limit their losses. Illustrate squeeze concept. This buying pressure then fuels further price increases, forcing more shorts to cover, creating a cascading effect. When a stock like WLDS has a very high cost to borrow, that pressure intensifies dramatically. Every day a short seller holds their position, they're bleeding money in fees. If the price starts to move up, even slightly, the combined pressure of rising price and sky-high borrow fees can force them to close their positions rapidly, leading to a potentially sharp increase in price. However, it's crucial to understand that a high CTB does not guarantee a squeeze. It can also indicate that short sellers have strong conviction and are willing to pay a premium to maintain the bearish bet. Dilution risk check. Before getting too excited, it's vital to check for dilution risk. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. Explain dilution. This can offset or completely negate a short squeeze thesis because more shares mean the short sellers have a larger pool of shares to buy back from, easing the pressure. It also dilutes the value of existing shares. For WLDS, our checks found no recent dilutive SEC filings such as -1s, -3s, or 424BS in the last 90 days. We also found no recent reverse splits for WLDS in our look-back window. This is a positive sign, as it means there aren't immediate, obvious mechanisms for new shares to flood the market and dampen a potential squeeze from the company's side. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Given WLDS's unique situation, a microcap with zero volume and zero price movement, yet an astonishing 10.07% cost to borrow and a 1.9 million estimated float, what should you watch for? The key missing ingredient right now is volume and price momentum. For a squeeze to ignite, you typically want to see a significant uptick in trading volume accompanied by a sustained price increase. This would put pressure on those short sellers who are paying exorbitant daily fees. Short chart with empty volume bars right now, WLDS is incredibly quiet. The high CTB is like a coiled spring, but it needs a catalyst to unwind. Without any recent dilutive actions or reverse splits, any sudden influx of buying interest could theoretically have an outsized impact due to the tight share structure and high borrow costs. However, it's a very speculative setup given the current lack of market interest. WLDS presents a textbook example of a stock showing extreme hard-to-borrow characteristics, with its jaw-dropping 10.03.7% cost to borrow and a tiny 1.9 million share float. While the lack of recent price action and volume makes it a curious case, these underlying metrics are exactly what we look for when identifying potential short squeeze candidates. Remember, a high cost to borrow is a signal, not a guarantee. It means the short side is under increasing financial pressure, but it doesn't mean they will buckle. Always conduct your own thorough due diligence. If you found this breakdown insightful, please hit that like button, subscribe for more unique stock analyses, and let us know in the comments what other hard-to-borrow stocks you'd like us to investigate next.